real estate has many advantages, but in of itself, but it also has a disadvantage of you're locked in and you don't get out as easily as you got in. Where in the market you can. So what does that mean? Traditionally, you start with the what we call the liquid assets, so that you can, if an emergency comes, you can have those. And then you build up more and more as you go forward into the non-liquid, and then you go to the higher risk, which may not be as liquid even if it's in the market.
Sure, sure. And that's one of the things that, you know, again, you have to understand when going into the market. The way to really enter into an investment is we like having a more liquid asset in the beginning.
Right.
But really what I try to do when sitting down with somebody and helping them think about investing is once you become an investor, you never stop. Sometimes people have a mindset of, I'm going to get in there and make a lot of money and then get out and just live on that money. That is not how you play the game. Once you're an investor, you never stop. I mean, if you start making money, why would you want to stop? So while we say that you're looking at liquidity, it's not something that you want to get in and out and in and out. The way you invest, particularly long-term, and when you're talking about retirement and growing your assets, is with a long-term mentality. You do it with intervals as often as you can, whether that's weekly, monthly, quarterly, but as often as you can, and you make that a repetitive action that you continue to do when the market's up and when the market's down. And you don't look at statements when they're down and try to pull out of the market, because that's trying to time it, and you can't do that. So while we say liquidity is important and you start there, you do, I want you to think about the mindset of being, I'm an investor and I'm never not going to be an investor, and I'm going to leave that for my retirement.